Welcome back, everybody, to another deep dive into a fascinating piece of market research.
Yeah.
Today, we're going to be talking about the 29th Annual Wealth Creation Study put out by Motilal Oswal Financial Services Limited.
So good.
It covers the years 2019 to 2024.
Okay.
And it's got a ton of really interesting insights about wealth creation in the Indian stock market. But what really caught my attention was the idea of these bruised blue chips.
Mm-hmm.
So I thought we could start off by just defining what we're even talking about here when we say bruised blue chip.
Sure. Yeah. I mean, I think most people know the idea of a blue chip company, right?
Yeah, for sure.
Like your established companies with a long track record of profits, like Reliance Industries,
Big
TC.
CS.
Yeah.
Everyone knows.
Yeah.
So what makes them bruised?
Well, so you take that company that's got this great track record, and then something happens and the stock price just takes a hit, right?
Oh, okay.
And it could be all sorts of things.
Oh.
Sometimes it's a big external factor like a recession. I don't know, if you think back to COVID,
Right.
even the strongest companies got hit pretty hard.
Yeah.
This study gives the example of Indian hotel, like the Taj hotels, right?
Oh, wow.
Like luxury hotels.
Yeah.
They dropped 62% during that time.
Yeah. Travel just stopped.
Exactly. Nobody's flying. Nobody's going on vacation. And even the really fancy hotels suffer.
Right. Even the top tier.
Yeah, absolutely.
So it doesn't necessarily mean there's something wrong with the company.
Right. It could just be that the whole world is going through something.
Yeah.
Or it could be something specific to their industry.
Oh, okay.
Like the study talks about Suzlon Energy back in 2012.
Yeah.
They're a big player in wind energy. And when the government changed some incentives for renewable energy, it really hurt their business.
Makes sense.
And, their stock price went down along with it.
So you could have a fundamentally sound company, but some big external event
Right.
knocks them down.
Exactly. And that's where the opportunity comes in.
Oh, interesting. Okay.
Because sometimes those same forces that cause the bruising can also help them heal.
Oh, how so?
Well, so you take Suzlon.
Okay.
In recent years, with a big push for renewable energy.
Right.
Wind power has taken off.
Yeah.
And Suzlon stock has actually rebounded pretty significantly.
Oh, wow. So it's like the tide turned.
Yeah, exactly.
And now they're riding the wave.
Exactly.
That's interesting.
So it's not always about internal problems.
Okay. So what about those internal problems?
Yeah, so those definitely happen too.
Right.
Sometimes a company makes a strategic decision that just doesn't work out. Like the study talks about Tata Steel.
Okay.
Back in 2008, they acquired this UK-based steel company called Chorus. And it was a mess.
Oh, really?
Yeah, integration problems, cultural differences, all kinds of stuff.
Wow.
And Tata Steel ended up losing a lot of money.
Ooh.
Their stock took a big hit.
That's a bad acquisition.
Yeah, for sure.
So are there other internal things investors should be looking out for?
Oh, yeah, definitely poor management decisions. The study uses this example of CG Power.
Okay.
They were considered a blue chip for a long time until this huge financial scandal in 2012.
Oh, wow.
Basically, it was just bad corporate governance, and their stock price totally tanked, became a penny stock, and eventually got taken over by another company. So, yeah, that's another thing to watch out for.
So, bad acquisitions.
Right.
Bad management.
Yep.
Anything else?
Well, debt can be a big one.
Oh, yeah.
Like the study talks about Jindal Steel, they took on a ton of debt to fund this big expansion. And when things didn't go as planned, they were stuck with this massive interest burden.
Oh, man.
So their profits went down, their stock price went down. It can be a vicious cycle.
So it seems like there's a lot of ways a company can get in trouble.
There are, yeah.
But we're talking about blue chips here, right?
Yeah.
These are companies that have a history of success.
Right, exactly.
So even when they face these challenges, they often have the resources and the strength to bounce back.
That's the idea.
Okay, it's good to hear.
Yeah.
But I am curious, how exactly do these companies heal from those internal wounds?
Yeah.
What are the signs that a turnaround might be on the horizon?
Well, sometimes it's as simple as a change in management.
Oh.
The study talks about ICICI Bank. They brought in a new leadership team, revamped their strategy, and they were able to recover pretty effectively.
Oh, wow. So new blood.
Yeah. Fresh perspective can make a big difference.
Okay.
Sometimes companies need to restructure their operations. Like the study points to Mahindra and Mahindra.
Right.
They streamlined their business, sold off some underperforming units, and they became a lot more profitable.
So like a good spring cleaning.
Yeah, exactly. Get rid of the dead weight.
Makes sense.
And their stock price reflected that transformation.
Oh, cool.
You know?
It went up.
So restructuring new management. And what about that debt issue we talked about?
Yeah, so debt reduction is key.
And the study actually gives several examples of companies that successfully tackled this.
Oh,
Like Jindal Steel that we mentioned earlier.
right, they had that big debt.
Yeah, they really went after it, selling assets, optimizing operations, and they were able to bring that debt load down significantly.
That's impressive.
Yeah, it takes a lot of discipline.
Okay, so we've talked about all the things that can cause these blue chips to stumble both external and internal, and we've looked at some ways they can recover.
Right.
But let's get to the heart of the matter here.
Okay.
Why should investors care about these bruised blue chips?
Yeah, good question.
What's the opportunity here?
So the opportunity is the potential for these really big returns.
Oh, okay.
Because remember, these are fundamentally strong companies that are temporarily undervalued.
I see.
So their stock prices have taken a hit, which creates a buying opportunity for savvy investors.
So it's like getting a discount on a high-quality product.
Yeah, exactly.
But in this case, the product is a piece of a potentially very profitable company.
Exactly.
I like that analogy.
Yeah, and the study actually provides some evidence to back this up.
Oh, okay.
Like, they looked at the performance of bruised blue chips over a 10-year period, and they found that they generated an average return of 55%.
Wow.
Compared to just 23% for non-bruised blue chips.
55 versus 23.
Yeah, that's a big difference.
That's huge.
So there's definitely potential there.
Wow. Okay, so is there something like inherent to bruised blue chips that makes that higher return more likely?
Yeah, I think so. One of the key factors is this concept of asymmetric payoff.
Okay, I've heard that term before, but I'm not sure I totally understand it.
Yeah, so basically it means that the potential upside significantly outweighs the potential downside.
Okay.
Because the stock price has already fallen.
Right.
The risk of further losses is somewhat mitigated.
I see.
But the potential for a rebound, for the price to go back up to its previous level or even higher, that's where the real opportunity for profit is.
So the risk is already kind of baked in,
Exactly.
but the potential for growth is still there.
Yep.
That does sound pretty compelling.
Yeah, it's a powerful combination.
Okay, but how do we as investors actually put this knowledge into practice? How do we identify those bruised blue chips that have that potential
Right.
and separate them from the companies that might be facing more serious problems?
Yeah, that's the million-dollar question, right?
Right.
Well, the study actually provides a roadmap for investors to follow.
Okay, I'm all ears.
So the first step is creating a watch list.
Okay.
A list of potential candidates to investigate further.
Makes sense.
And the study recommends starting by identifying blue chips that have experienced a price drop of at least 30%.
30%? That's a pretty steep drop.
Yeah, it is.
But we can't just buy every blue chip that's down 30%.
Oh, definitely not.
There's got to be more to it than that.
Yeah, so that's just the starting point.
Okay, what's next?
The next step is crucial. You have to investigate why the price has dropped. Like, is it due to temporary external factors like a recession, or is there something more fundamental going on?
I see. So we need to do our due diligence.
Exactly. You got to be a detective.
Okay.
Look at the company's financials, understand their industry, see if this is a temporary setback or something more serious.
So basically figure out if the bruise is just a flesh wound or if it's something more serious.
Yeah. Okay.
That makes sense.
You got to separate the bruised blue chips that have the potential to heal from the ones that might be facing permanent challenges.
I like that.
Yeah.
Okay, so we've made our watch list.
Mm-hmm.
We've done our homework.
Yep.
We've investigated the reasons for the price drop.
Right.
What's the next step in this process?
So now we need to look for what we call healing triggers.
Okay.
Signs that a turnaround might be in the works.
Like what kind of signs?
Well, is there a new management team in place with a solid plan to address the company's challenges?
Okay.
Has the company taken steps to reduce its debt burden? Are there positive shifts happening in their industry that could create a more favorable environment for growth?
So we're looking for those signs of life.
Yeah, exactly. Those green shoots that suggest the company's on the mend.
Okay.
Because those healing triggers give us confidence that the company's bruises are temporary.
And that the price drop is a genuine opportunity.
Exactly.
Okay, so we've identified potential bruised blue chips.
Mm-hmm.
We've investigated the reasons for their decline.
Right.
We've looked for healing triggers.
Yep.
What's the final piece of the puzzle?
So the final and arguably most important step is valuation.
Oh, right.
Just because a company's price has dropped doesn't automatically make it a good investment.
Makes sense.
We need to determine if the current price represents genuine value.
Okay, how do we do that?
So one of the key metrics the study recommends using is the price-to-book ratio.
Oh, okay. Can we break that down for a second?
Sure.
I know some of our listeners might not be familiar with that term.
Yeah, so the price-to-book ratio, or PB ratio,
Mm-hmm.
is a valuation metric that compares a company's market capitalization to its book value.
Great.
And the book value represents the company's net assets, which is basically what would be left over if you sold all the company's assets and paid off all their liabilities.
I see.
So the PB ratio tells us how much investors are willing to pay for each dollar of the company's net assets.
Okay.
A lower PB ratio generally suggests that a company is undervalued, while a higher PB ratio might mean it's overvalued.
So in the context of bruised blue chips, we're looking for companies with a lower PB ratio.
Exactly, because it suggests that we're getting more bang for our buck.
I like it.
And the study specifically suggests looking for bruised blue chips with a PB ratio of around 2x or less,
Okay.
which means that the market is valuing the company at less than twice its net assets.
I see.
And that could be a signal that it's a good time to buy.
Okay, so to recap, our four-step process is create a watch list of companies that have dropped at least 30%.
Right.
Investigate the bruising, look for those healing triggers, and finally make sure the valuation makes sense, particularly focusing on that PB ratio.
Exactly.
Sounds like a very sound approach.
Yeah, it's a framework that combines both quantitative and qualitative analysis to help investors find those hidden gems in the market.
This has been incredibly insightful, and I'm sure our listeners are eager to hear about those specific companies highlighted in the study,
Yeah, for sure.
particularly those that have demonstrated remarkable wealth creation.
Right.
But we'll delve into those fascinating success stories in the next part of our deep dive, so stay tuned.
Looking forward to it.
Welcome back to our deep dive into the world of bruised blue chips. Before the break, we talked about how to identify these potentially undervalued companies. I'm really excited to get into some of the specific companies the study highlights, especially those that have really delivered for investors, those wealth creators.
Yeah, me too. I mean, there are some pretty incredible stories in here.
Yeah, so let's start with those fastest wealth creators, the ones that really took off during this period. What were some of the standouts for you?
Well, the top 10 list is really impressive. You know, it shows you what's possible when you identify those bruised blue chips and catch them on that recovery wave like Adani Green. Remember, we talked about them earlier?
Yeah, their stock went crazy, right?
Yeah, they topped the list. Their price CAGR was 118% over the 5-year period.
118%. That's like your investment almost doubling every year.
Yeah, that's pretty wild, right?
Makes you wonder what they're doing right.
Well, in their case, they were really well positioned to capitalize on that global shift towards renewable energy. You know, they're all about sustainable solutions, and that's a huge growth market right now.
Yeah, the whole world is going green.
Exactly. So they were in the right place at the right time with the right strategy.
It's like catching a tidal wave.
Yeah, and they rode it all the way to the top.
Wow. Are there any other companies on that fast track, like Adani Green?
Oh, yeah. There are a bunch of companies with impressive price KGRs like Adani Enterprises at 85%, Jindal Stainless at 77%. These are companies that are really firing on all cylinders.
Those are some serious numbers.
Yeah, for sure. It shows you the potential rewards of identifying those companies with the right ingredients for explosive growth.
Right, but fast growth isn't always sustainable, right? Like, what about those investors who are looking for something a little more steady? Those consistent compounders that deliver reliable returns over time.
Yeah, you bring up a good point. Consistency is really important, and the study highlights some great examples of that too, like Linde India. They stand out as the most consistent wealth creator. They actually outperformed the market in each of the last 5 years with a price CAGR of 68%.
Wow, that's consistency.
Yeah, it's impressive, right? Like a well-oiled machine.
It really speaks to the strength of their business.
Exactly. They've clearly got a solid management team and a strong competitive advantage.
It's a good reminder that investing isn't always about chasing the latest fad. You know, sometimes it's about finding those solid, reliable companies that can deliver over the long haul.
Absolutely. Slow and steady wins the race, right?
Exactly. Okay, so we've got those fast growers and we've got those consistent compounders. But what about the companies that do both, like the ones that combine growth and consistency? The study calls them all-round wealth creators. Right?
Yeah. Those are the superstars, the ones that seem to have it all. And you know who topped that list?
Let me guess, Adani.
You got it. Adani Enterprises, they were #1 for the 3rd time in a row.
Wow, they're on a roll.
Yeah, they're really killing it. Their consistent presence in this category shows that they can not only grow rapidly, but they can sustain that growth over time, which is really impressive.
It's like they've cracked the code.
Yeah, they figured out how to win in multiple ways.
So Adani Enterprises is the top dog. Are there any other notable all-rounders?
Oh, yeah, for sure. Hindustan Aeronautics, Varun Beverages, even Adani Power shows up again. They're all up there in the top 10. They're all excelling in multiple aspects of wealth creation, growth, profitability, efficient capital allocation. They're the whole package.
So these are companies that investors can feel really confident about?
Yeah, if you're looking for companies with a proven track record of success, these are definitely worth a closer look.
Okay, I love that the study doesn't just focus on the big names, though.
Yeah.
They also highlight those companies that have made these incredible jumps in market cap rankings, those mini to mega leaps, as they call them.
Oh, yeah, those are some of the most inspiring stories. Those companies that transition from being relatively small and unknown to becoming major players in the market.
It's like the underdog story.
Yeah, exactly. During the study period, 23 companies made the jump from mid-cap to mega-cap, which is a pretty big deal.
It's a huge leap.
Yeah, it shows that they've really hit their stride and their valuations have exploded.
So Adani Green is obviously one of those big winners.
Yeah.
What are some other examples?
Well, Adani Transmission is another one. Tube Investments of India Pidilite Industries. They've all made these impressive jumps in their market cap rankings. It's a testament to their strong leadership, their effective growth strategies, and their ability to capture market share.
It's like watching a David versus Goliath story unfold in the stock market.
Yeah, but in this case, David wins.
That's awesome. Okay, so we've got the mini to mega leaps. But what about those companies that made the first step on that upward trajectory? The ones that transitioned from mini cap to mid cap.
Right, so those are the companies that are just starting to break out. And the study identified 27 of them, and their performance was pretty impressive too. They delivered an average return CAGR of 52%, which is a pretty strong indicator of their growth potential.
52%, that's nothing to sneeze at.
No, it's not.
Yeah.
It suggests that these companies are on the right track, and they're starting to establish themselves in a more competitive market segment.
So it's like a stepping stone to even greater success.
Yeah, exactly. And some of the standouts in this group are Jindal Stainless. We talked about them earlier. They continued their impressive run, showing that they can maintain that momentum.
Right.
But also companies like Dixon Technologies, Linde India, CG Power Persistent Systems, they all demonstrated the potential that exists within the mini-cap space.
So it's like a breeding ground for future stars.
Yeah, exactly. It's a great place to look for companies that are poised for big things.
Okay, so we've focused a lot on the positive stories, the companies that are creating wealth, but we can't ignore the other side of the coin. Right? What about the companies that struggled during this period? The ones that experienced wealth destruction rather than creation?
Yeah, that's an important point to remember. Not every investment is going to be a winner.
Right.
And the study actually dedicates a whole section to analyzing wealth destruction.
Oh, interesting.
Yeah. So as with wealth creation, there are both external and internal factors that can lead to companies losing value.
Like what kind of things?
Well, externally, you've got things like economic downturns, changes in government policy, increased competition. All of those things can really hurt a company's bottom line.
Yeah, the world can be a tough place for businesses.
It can. And then internally, you've got things like poor management decisions, inefficient operations, and inability to adapt to changing market conditions. All of those things can contribute to wealth destruction as well.
So it's like the flip side of the same coin.
Exactly the same forces that can propel a company to success can also lead to its downfall.
That's a sobering thought.
It is. But it's important to be aware of those risks.
Absolutely.
Right.
So did the study highlight any specific sectors that experienced significant wealth destruction during this period?
Yeah, so besides the financial sector, which we talked about earlier, the material sector was hit pretty hard.
Oh, really? Why is that?
Well, a lot of it had to do with declining commodity prices, rising input costs, and those global trade tensions that were happening.
Right, all those external factors.
Exactly. They really put a dent in the sector's overall performance, even though there were some strong individual companies within that sector.
So it's not enough to just pick the right industry.
Nope, you got to pick the right company within that industry.
Right, because even in a sector that's doing well overall, there will be winners and losers.
Absolutely. The study actually points out that while the financial sector was the largest wealth creator during this period, it was also the biggest wealth destroyer.
Oh, wow, that's interesting.
Yeah, it's a reminder that you really need to do your homework.
No shortcuts.
Nope. Careful research and due diligence are essential.
Okay, so we've talked about the private sector. But what about those public sector undertakings, the PSUs? How did they fare during this period?
That's a good question. Traditionally, PSUs haven't always been viewed as the most dynamic or growth-oriented companies.
Right. They've got that reputation for being a little slow-moving.
Exactly. But interestingly, the study actually shows a pretty notable improvement in their performance. Their contribution to wealth creation actually reached a 5-year high.
Oh, wow. That's a turnaround.
Yeah, it seems like they're starting to step up their game.
So what's driving this positive shift?
Well, a couple of things seem to be at play. Firstly, there's been a conscious effort to improve efficiency and corporate governance within PSUs.
Okay, so they're getting their act together.
Yeah, they're becoming more competitive.
Yeah.
And secondly, some of the sectors where PSUs have a strong presence, like energy and industrials, those sectors actually benefited from favorable market conditions during this period. So they had a little bit of a tailwind.
Yeah, exactly. The stars kind of aligned for them.
So it's a combination of internal improvements and external factors.
Yeah, they were able to capitalize on the opportunities that presented themselves.
It's a good reminder that even those companies that have a reputation for being less agile, they can adapt and thrive in the right circumstances.
Absolutely. It just goes to show that change is possible, even in sectors that are traditionally perceived as being a little bit slower moving.
I like that positive message.
Yeah, it's all about creating the right environment for success.
This has been a really fascinating discussion. We've explored the incredible journeys of those fastest wealth creators, the steady performance of those consistent compounders, and even the dramatic leaps made by those mini to mega transformers.
It's been a wild ride through the Indian stock market. It has, but the study doesn't stop there. They also take a broader perspective looking at the overall dynamics of the market and how companies transition between those different market cap categories. We'll explore those insights and wrap up our deep dive right after the break. All right, we are back and ready to wrap up our deep dive into the world of bruised blue chips.
Yeah, excited to see where we land with this.
Right before the break, we were talking about how the study zooms out and looks at the whole market. Using this thing they call the market cap rank crossover matrix.
Yeah, the matrix it shows us how companies are moving between those different market cap categories. Your mini caps, mid caps, mega caps.
So instead of just focusing on individual companies, we're getting a sense of the overall flow of the market.
Exactly. It's like watching a time lapse of the stock market. You see how these companies are growing and evolving over time.
I like that. Okay, so what kind of insights does this matrix reveal about the Indian stock market during the study period?
So for 2019 to 2024, it highlights some pretty clear trends. First, it shows us those big jumps we talked about earlier, like Adani Green going from mini cap all the way to mega cap. Remember that 118% price? CAGR?
Yeah, that was wild.
But it also shows us those companies that made those smaller but still significant transitions.
So we're not just seeing the superstars.
Right, we're seeing the whole ecosystem.
The companies that are steadily climbing the ranks.
Exactly, building their presence in the market.
Okay, so the matrix highlights those mini to mega jumps, but also those mini to mid transitions.
Right, and that's a key takeaway. Actually, 27 companies made that mini to mid leap during the study period.
Yeah.
And out of those 27, 9 of them ended up in the top 100 wealth creators.
Wow.
Delivering an average return CGR of 60%.
60%? That's way higher than the Nifty 50.
Yeah, it is. Nifty only returned 14% over the same period.
That's a huge difference.
So it really shows you the potential of identifying companies early in their growth cycle, before they become household names.
Yeah, like getting in on the ground floor. Okay, what about those companies that moved from mid cap to mega cap?
Now, this is where things get really interesting. 23 companies made that transition during the study period.
Okay.
And get this, 21 of them made it to the list of the 100 biggest wealth creators.
Wow.
With an average price CAGR of 40%.
So almost all of them.
Pretty much, yeah. It suggests that once a company reaches that mega cap status, they've not only achieved scale, but they've also figured out how to stay competitive.
And keep growing, even among the giants of the market.
Exactly. They're playing in the big leagues now.
This has been a really eye-opening discussion. We've explored the world of bruised blue chips. We've learned how to identify them, how to evaluate their potential. And we've seen some incredible examples of companies that have turned those bruises into opportunities for growth.
Yeah, it's all about finding those diamonds in the rough.
Exactly. So as we wrap up this deep dive, what's the one key takeaway you want our listeners to remember?
I think the biggest lesson here is that even when a company's stock price takes a hit, it doesn't necessarily mean it's game over. Those bruises can actually create opportunities for savvy investors who know what to look for.
Like those old boxing movies.
Yeah.
The fighter gets knocked down, but they find a way to get back up and win the fight.
Exactly. It's about resilience. It's about having the strength to overcome those challenges and come back stronger.
And the study gives us a roadmap to identify those companies that have that fighting spirit.
Exactly. The framework we discussed, creating that watch list, investigating the bruising, looking for those healing triggers, and making sure the valuation makes sense, that's how you find those potential champions.
And remember, folks, the watch list provided in the study is just a starting point. You need to do your own research, understand the specific circumstances of each company, and evaluate the risks and rewards before making any investment decisions.
Investing is a marathon, not a sprint. It takes time and patience, but with the right knowledge and a bit of courage, you can navigate the market and potentially achieve your financial goals.
So there you have it, a deep dive into the world of bruised blue chips, wealth creation, and the Indian stock market. We hope you found it insightful. And remember, folks, invest wisely. Stay informed and happy investing.